As a dividend investor, I like to hold companies for as long as possible because over time, the price that you paid, especially if the dividends are growing over time, means that your return is getting better and better as time goes on. But sometimes a company that you've purchased isn't performing as usual anymore, and you think it might be time to sell. Now, generally, I only sell once per year when I do a portfolio rebalance. There are exceptions when a company is doing particularly bad, but that doesn't happen very often. Most of the time, I'm selling if a company is not performing as well when I do my portfolio rebalance, which is about once a year. Mostly I do that because I don't like to rush into selling something too soon in case the company turns around again. So I thought I'd share the three main reasons of why I would sell a company. So in this video, let's go over those reasons so you can also decide whether it's time to sell a company. Hang on. Yeah, I don't think it's going to work out. I'm really sorry. No, it's just that you've been losing interest for a long time. I've been losing interest for a long time. You're not paying me any money anymore. And well, you've taken on a lot of debt and no, I think it's over. Sorry. Now, the first main reason I might drop a company that I've been holding for a long time is a falling share price. Now, on the surface, a falling share price isn't always an indicator that you should be selling the shares. It depends on a lot of factors. I usually ignore market volatility. I certainly don't look at the stock market every single day to look at the price fluctuations, and I won't sell during a general market downturn because all companies are falling, so it's not an indication that that particular company is failing. In fact, you know that when the whole market goes down, it's actually a great time to buy because everything's on sale. Usually during those sorts of periods, it's usually just a waiting game to wait until the market recovers. Now that could be 6 months, it could be a year, it might even be longer, but usually if the price is falling because of a general market fall or crash, most companies should recover, especially if they've been great in the past. However, a falling stock price in a company, especially if there's a general downtrend on the chart over a long period of time, could be an indication that it's time to ditch that dividend paying company, even if they're still paying dividends. Now, I like to look at the stock chart over 2 time frames. One is over 1 year, so a shorter time frame, and one is over a longer term, usually 5 or 10 years. So over the long term, over the 5 or 10 year period, you want to see a general uptrend. There's going to be dips at certain times in that chart, but generally you want to see an uptrend over the long term. If you do, that could be an indication that it's a stock to keep. But over the shorter time frame, it's a little trickier to work out because then you have to compare it to the rest of the market as a whole. Just having a look at any of the major indexes to see what the market is doing generally, so whether it's in an uptrend or a downtrend, or whether it's just stagnant and not really moving at all, you want to compare that 1 year chart of the company that you own to the 1 year general trend of the market. If it's about the same, there's no reason to sell the company. But if there is a major difference, like if it's been falling over the past 12 months, whereas the rest of the market is going up, that's an indication to sell. Now, the next reason that you might want to sell a dividend paying stock is because of a falling dividend. This one's probably the most obvious because as a dividend investor, you're using that dividend as income for yourself. And if it's falling, you don't want to be going backwards. Now, I just want to go over quickly that a falling dividend yield is not the same as a falling dividend overall, because usually what happens is the dividend yield is just a calculation and it's only really useful when you're buying because it's based on the current share market price and the last dividend that was paid. But if you've bought at an earlier price, which is obviously different to the current price, the dividend yield isn't going to make a lot of difference to you. So what you need to be looking at instead is how much they're paying cents per share. So usually a company will announce how much it's going to pay based on how much you hold. So let's say you own 100 shares in a company and it pays out 20 cents per share. But over time it starts to decrease, like it might then pay 19 cents per share and then maybe 15 cents per share. That's a falling dividend. Now, companies can pay different amounts of their dividends throughout the year. There's usually 2 periods in Australia that they pay. They pay an interim dividend and a final dividend. So often the interim dividend and the final dividend will be different. So if you want to see if the dividend is falling, you really need to compare the interim dividend of this year to the interim dividend of the previous year and same with the final dividend. Sometimes it's just easier to work out how much dividends they've paid over the entire year and compare that to the previous year. And this is really a good way to look at the dividend stability too, to make sure that not only is the company paying similar amounts each time, but the company is growing over time, because dividend stability is very important if you're an income investor. There are some exceptions to this as well, like we've just seen in 2020 when a lot of companies did reduce their dividends or deferred them. Especially in Australia, the banks did that. So in this situation, you want to look at why they've dropped the dividends and if there's a reasonable explanation for doing so. So in this case, in 2020, I did not sell any of the banks. I'm waiting for them to increase the dividends, which they're starting to do right now. But I did get rid of one company that halted the dividend because not only did they stop paying dividends, the share price was falling and it was just generally not fitting my criteria anymore. So to summarize this, if the dividend is falling over the long term, it's time to sell. And the third reason that I might sell a dividend paying company is because the company fundamentals or the financials have changed in a way that I don't feel comfortable holding the company anymore. One of the financials that I do look at particularly is the debt to equity ratio. I don't like holding companies that hold a lot of debt. So it's usually one of my criteria when buying a company. But when I'm holding a company and the debt has increased, while it's not an indication that I will sell just based on that alone, it is an indication that I may be looking at that company more heavily. Now, the reason I don't like holding companies with a lot of debt is because if the debt is higher than the equity and something happens, like there's a lockdown and the company can't do business, does mean that they won't be able to pay their loan repayments, and so the company could struggle if they don't have a lot of cash on hand. On its own though, just a high debt isn't an indication that the company's in trouble. It could be that they're expanding into new markets, they're marketing or researching a new product. There could be many reasons why a company is taking on more debt. That isn't a bad thing. But during a falling market, if the company has high debt, the first thing to go usually is the dividends. So I do always check the company financials, particularly the debt to equity ratio, when I'm doing a portfolio rebalance. And if a company has taken on too much debt, then it is pause and I will look at the rest of the financials to make sure that the company is stable. It's not always an indication that I will sell. Currently, Wesfarmers has a debt to equity ratio, I think it's around 100%. And I'm not selling Wesfarmers because they're a good dividend paying company overall, but that's because I checked the rest of the financials. Just want to point out too, if people are looking up the debt to equity ratio, that financial companies such as banks don't have this figure because they're the ones lending money, not borrowing it. Those are the three main reasons why I would sell a dividend paying company, even if they were still paying dividends. Selling isn't something I do often. I usually only do it once a year during a portfolio rebalance, and even then I don't sell every single time. I certainly have had years where I've sold nothing. I've kept every single company because they still fit my criteria, and there's been other years where I might sell 2 or 3 companies within my portfolio and go and find a better company that fits my criteria better. Because sometimes you have to let go of a company because a better company is just around the corner. Sorry. Hey babe. Yeah, what's up? So I hope you found this video useful. Thanks so much for watching, and I will see you in the next video. Bye.